Marginal costing. How to start and finish studying. Have a bird's eye view of the entire syllabus. Study each topic thoroughly. Never ever resort to shortcuts in study. Work out examples, illustrations and exercises. Repeat until you understand. Practice exam questions. Practice mock exams. Simulate exam conditions and practice. Marginal costing. In this lesson, we learn everything about what marginal costing is, how it is used, concept of contributions and the contribution to sales ratio, concept of break-even point, break-even chart, application of marginal cost in pricing policy and deciding price, decide whether to make, sell or buy from outsiders. Altogether, we discuss and practice questions based on these concepts, identify and work out examination problems. Marginal cost. In chapter 29, we saw how total costing can be used to determine price and profit, but beyond that, uses can be limited. In chapter 28, we identified classification of costs as fixed or variable. In this chapter, the distinction between them is important. The distinction is that variable costs increase in direct proportion to changes in the level of output. Within a certain range, fixed costs remain unchanged as output increases or decreases. For many management decisions, it is necessary to know the marginal cost of a unit of production. Marginal cost can be described as the cost of making one extra unit of an item. It is based on the principle that an additional unit of production will only result in an increase in the variable cost and that the fixed cost will not be affected. Marginal cost of production is therefore the total of variable cost of production. Remember that both terms relate to the same thing. This is called a contribution because it is the contribution that each unit of the production makes towards covering the overheads and providing a profit. Marginal cost, the cost of making an extra unit of output. Contribution, the difference between the selling price and variable cost of a unit or a unit of output. In total, it is also the difference between the total revenue and total variable cost. See, in marginal costing, we prepare a cost sheet like this. Variable costs, so which will be direct material, direct labor, direct expenses, that will be for the end cost. So to that, when you add variable overheads, you get marginal cost of production. So when you add fixed overheads to that, you get total cost of production. And when we add profit to that, that will give selling price. So what is contribution? Contribution is nothing but selling price minus marginal cost of production. So that is what is contribution. In other words, fixed cost is excluded to find contribution. The contribution per unit is calculated as follows. Selling price per unit less the total of the variable cost per unit. The calculation of contribution either in total or per unit is an important aspect of marginal costing. Ensure that you are fully aware of what it is. Contribution to sales ratio. This is also known as PVR ratio. This ratio of the contribution to the selling price is known as the contribution to sales ratio. This is very useful ratio that can be used to calculate the answers to many problems. The use of CS, contribution to sales ratio, avoids the need to spend valuable time calculating marginal cost. The break-even point. The point at which a business or a product makes neither a profit nor loss is the break-even point. Managers need to know the break-even point of a product when making decisions about pricing, production levels and other matters. Break-even occurs when total contribution equals total fixed cost, or alternatively when total revenue minus total variable or margin cost equals fixed cost. It is found by dividing the total fixed cost by the contribution per unit. The calculation gives the number of units that have to be produced and sold before the fixed costs are covered. When the calculation of a break-even point results in the fraction of a unit of production, the answer should always be rounded up to the next complete unit. For example, so 32,000 divided by 23, 1391.304. You have to round it off to 1392, not 1391, because a product cannot be a fraction. So it should be always the next number. Always indicate whether the break-even figure you have calculated is in dollars or units. The formula of selling price minus variable cost can also be extended to calculate how many units need to be sold to earn a required level of profit. Break-even chart. A break-even chart is a diagrammatic representation of the profit or loss to be expected from the sale of a product at various levels of activity. The chart is prepared by plotting the revenue from the sale of various volumes of product against the total cost of production. The break-even point occurs where the sales line cuts the total cost line where there is neither profit nor loss. Suppose the marginal cost of a product exists $10 per liter. It is sold at for 22.5 per liter. Fixed costs are $50,000. This can be shown using a break-even chart as follows. So across this is the revenue, is the amount. Across this is the quantity, output in units. So across this you can see there is margin of safety, fixed cost, revenue, profit, everything. So the break-even point is where the revenue and total cost line intersect. The break-even point, this is the point. The line AB shows the line AB shows the revenue at break-even point 90,000. So this is the break-even point. This is the break-even point, and the line BC shows the output in units. BC shows the output in units. So this is the quantity at which there is break-even. So beyond this is margin of safety. This is margin of safety. This is margin of safety. So this shows output units at break-even point. At 10,000 units, the revenue is 225,000, 225,000, and total cost is 150,000. The distance between those two lines shows a profit of $75,000, the distance. So the difference between the revenue line and the total cost line before the break-even point represents the loss that will be made if the output falls below 4,000. This is the loss. So the area beyond the break-even point represents profitable level of sales. Beyond that point is profitable level of sales. The difference between the break-even point and 10,000 units is the margin of safety. Difference between this and this is margin of safety. This is the margin of safety. So, or the amount by which the output can fall short of 10,000 before the business risk, making a loss on product X. It may be expressed as a number of units 6,000 or as a percentage of 60%. 60%. Margin of safety is 60%. Profit volume charts. Break-even charts may also be drawn to show only the profit or loss at each level of output. The cost and revenue lines are omitted. The break-even chart for product X given in the example above could be drawn as a profit or volume chart. Profit volume chart for product X. At zero output, the loss equals the total of the fixed cost $50,000. At 10,000 units, the profit is equal to $75,000. A straight line joining 2 points intersect the output line at the break-even point. Make sure that if you are asked to prepare a break-even chart, you don't prepare a profit volume chart or vice versa. The limitations of break-even charts. Break-even charts are useful visual aids for the study of the effect of changes in output cost and revenues on the break-even point, especially for managers with little accounting knowledge. The charts, however, have their limitations. It is important that you know the limitations of break-even chart. Try to learn them thoroughly. If revenue and costs are represented by straight lines, they may be misleading. Maximum revenue may also be achieved if customers are given attractive discounts, while variable costs may be affected by quantity discounts when output is increased. These factors would be more accurately represented on charts by curves rather than the straight lines. Some costs may be semi-variable. In other words, there is both an element of fixed cost and an element of variable cost included in the cost in the total. An example of this is the telephone. The fixed element may be the line rental, which must be paid whether any calls are made or not. The variable element would be the call charges, which will increase each time a call is made in order to break even to work. The fixed and variable element must be calculated and added and with the appropriate figures. The charts may mislead people whose accounting knowledge is limited, but trained accountants will know when to make allowances for a chart's limitations. Many fixed costs are fixed only when certain limits and may increase with the level of activity. They are stepped costs or semi-variable costs. In order to prepare a break-even chart or work out the break-even point, it is essential to use only fixed and variable costs. Sometimes you may not be specifically told that certain costs are semi-variable. where for two different levels of output, the other costs have two different values in total and per unit. Marginal costing and pricing. The price at which a good may be sold is usually decided by a number of factors: the need to make a profit, market demand, a requirement to increase market share for a product, maximum utilization of resources, competition from other firms, economic conditions, political factors, price regulation, and so on. Marginal costing can help management to decide on pricing policy, but first it is necessary to understand that some expenses, such as selling expenses, may be variable. An example is sales people's commissions based on the number of units sold. When variable selling expenses are included in marginal cost, the result is the marginal cost of sales. So we can see direct material, direct wages, direct expenses, that will give marginal cost of production. Variable selling expenses will give marginal cost of sales. Other fixed expenses will give total cost. It is important to use the correct marginal cost when using marginal costing for decision making. Acceptance or order below normal selling price. There are occasions when orders may be accepted below the normal selling price. They may be considered when there is a spare manufacturing capacity and in the following circumstances: when the order will result in further contribution to cover fixed expenses and add to profit, to maintain production and avoid laying off of skilled workforce during a period of pure trading, to promote a new product, to dispose of slow-moving or redundant inventory. The rule is that the selling price must always exceed the marginal cost of production. If it doesn't, then each unit will be sold at a loss before taking fixed costs into account. Acceptance of orders below normal selling price. There are certain occasions when orders can be accepted below the normal selling price. These may be considered when there is a spare manufacturing capacity and in the following circumstances: when the order will result in further contribution to cover fixed expenses and add to profit, to maintain production and avoid laying off skilled workforce during a period of poor trading, to promote a new product, to dispose of slow-moving or redundant inventory. The rule is that the selling price must always exceed the marginal cost of production. If it doesn't, then each unit will be sold at a loss before taking fixed costs into account. Fixed expenses will not be affected by the additional production. If you are told that fixed costs will also change, remember to take this into account in your calculation. The question here is whether the order should be either you should accept either of the orders. Make or buy decisions. We already seen in chapter 20 that a manufacturing account may suggest that it should be more profitable for a business to buy goods from another supplier than make the goods itself. This involves make or buy decision. It may be relevant for the goods that are already being produced or the introduction of a new product. The decision will be based primarily on whether the cost of buying the goods from another supplier is more or less than the marginal cost of production. Notice that the marginal cost of sales is not relevant to this type of decision, as any variable selling cost will have to be incurred whether the goods are manufactured or purchased. The principle in this situation is that if marginal cost of production is below the price quoted by the supplier, then the offer should be rejected. Making the most profitable use of limited resources. Anything which limits the quantity of goods that a business may produce is known as limiting factor. Limiting factors include shortage of material, shortage of labor, shortage of demand for a particular product. When faced with limited resources, a company making several different products should use the limited resources in a way that produces the most profit. In a previous decision, the contribution per unit has been an important factor in making the decision. However, when making the best use of limited resources, the products must be ranked according to the amount of contribution they make from each unit of the scarce resource. Production will then be planned to ensure that the scarce resource is concentrated on the highest ranking products. You may be asked to calculate the profit if there is no shortage of material, and then revise profit taking into account the shortage of material. Ceasing the manufacture of a product. Another important topic, and one which marginal costing is important, is the decision whether or not to cease producing a product. Sensitivity analysis. In section 30.33, the sensitivity of contribution break-even points to change its cost and revenue was mentioned. This topic will now be covered in more detail, as estimates of revenue and cost will affect profit. By definition, estimates are rarely likely to be accurate, and allowances should be made in budgets for possible differences between estimates and actual cost and revenue. The point will be illustrated by taking the example of a high-risk situation. Marginal cost versus absorption cost and inventory valuation. When we look at FIFO and average cost, we saw that any difference in valuing and closing inventory will produce different profit figures. The two methods of costing, margin and absorption, will also produce totally different profits, as the closing inventory were valued in two different ways. Advantages and disadvantages of marginal costing. Using marginal costing has both advantages and disadvantages. They are set out below. Advantages of marginal costing. The technique is easily understood. The reason is that fixed costs are not included in the cost of production and there is no arbitrary apportionment of fixed costs. Contribution provides a reliable measure for short-term decision making. Marginal costing shows clearly the impact on profit of fluctuations in the volume of sales. Under absorption, over absorption, overheads are not a problem as there is no need to calculate an overhead absorption rate. The marginal costing technique can be used with standard costing. The technique shows the relative contribution to profit that are made by each product and shows where the sales effort should be contracted. Disadvantages of marginal costing. The disadvantages of marginal costing are perhaps the biggest disadvantage of marginal costing is that only useful for short-term decision making. Not all costs can easily be split into fixed costs and variable costs. Under margin costing, the fixed costs remain constant and variable costs vary according to the level of output. In reality, the fixed costs do not remain constant and variable costs do not vary according to the level of output. In the long run, all costs are variable. In the case of loss by fire, if inventory is valued using margin costing, the full amount of loss cannot be recovered from the insurance company since no element of factory fixed overhead is included. The management should not base decisions using contribution alone. The contribution may vary if new techniques are followed in production process. Leading on from this, the technique assumes that the production method will remain constant. In practice, this is not the case. Investment in new machinery at the expense of reducing labor will change the cost structure completely. It is really only useful or for a business which makes a single product. A company making several products will have difficulty allocating fixed cost to each product and with any degree of accuracy. This will make it difficult to calculate the break-even point for either a single product or the business as a whole. On balance, it may seem that the disadvantage of marginal costing are greater than the advantages. As we have seen, though, marginal costing is widely used for short-term decision making. This chapter has covered the basics of marginal costing, including what marginal cost is, how is it used, including how to decide on pricing policy for make or buy these decisions and to determine how much to make the most profitable use of scarce resources. The concept of break-even is an important one for business, and in this chapter we have learned not only what it is, but how to calculate it and how to prepare a break-even chart. You have to learn about the importance of contribution and contribution to sales ratio, the use of calculation of sensitivity analysis, how to value inventory using marginal and absorption costing. You should also learn what happens when orders from customers may be accepted below the normal selling price. Once again, there is no set layout when answering questions in this topic. Try to use tables for the answers. Setting things out in ways used in this chapter. Always make sure you fully label everything and show all your workings. This is an important topic area, so pay careful attention to it and work logically through practice questions.